So most UK investors are losing money with basic ISA mistakes. And I'm not joking, it's costing them thousands per year. So in this video, I'm going to break down 5 really clear and obvious mistakes. And I talked about this briefly on my TikTok and it kind of created a little bit of a debate. Now, if you are serious about building some wealth, I suggest you watch the entire video and hopefully you'll learn something and make some potential mistakes that could be actually limiting you to growing your savings or investments, of course. If you like my content, please do leave a like, subscribe, and more importantly, comment. Are you making these fatal mistakes? Now, the first mistake on the screen absolutely blows my brains because cash ISAs on a retail high street, where the biggest marketing kind of oomph is at people walking through their doors, where they see the leaflet to go, oh, I can save tax-free. Now, as I say, I put this on my TikTok. There's a link below to my TikTok in my all links if you're interested in me waffling randomness, but kind of created debate because I went, cash ISAs are a scam. Ugh. Let me explain it, because 1.10% interest is available here on Barclays, right? Now, these rates are painfully low compared to the inflation numbers, for example. They are painfully low versus, say, what you can get in the stocks and shares ISAs, which is what I'll come on to in a bit, regarding if you want to go into the bond market, for example, right? While they feel safe, you are literally losing money and purchasing power every single year without fail. The long-term element here is obviously cash ISAs are rarely the best option, but for most people in the public eye around the UK personal finance market, they are marketed to people that they are the best when they are really the not. Let me explain the opposite side of the spectrum if you shop around. Trading 212 is a platform that I use currently for my stocks and shares ISA, which this is different, by the way. This is the cash version, right? There's a link below if you are interested in an account here, but you can get 3.85%. It is a tracker rate, obviously. It is flexible. You can withdraw at any time. Let me come on to that in a bit. That's section 2. But you get the idea. It's completely free. There's another section on that as well, incoming. You're probably going to get the picture of this video very, very soon. You've also got to look at Monzo. Monzo lets you do it with an ISA or without an ISA with instant access, up to 3.5% paid monthly. It is a bank. It is a regulated bank that does the exact same thing. What's the difference? You're probably wondering. Well, you got to look at the obvious in the room: overheads, staff, and everything in between with the likes of Barclays. That is how high street banks make their most money, is via interest, funny enough. So yeah, you can do this, withdraw instantly anytime, no minimum deposit required, and you can do it in an ISA. Yeah, you get the idea. By the way, again, sorry for the plug, but there is a link below. If you are not a Monzo member, you can get some free money for even just signing up. Why not? It's a really good product. Now, you may have heard of Chase. They are an American bank, but they are in the UK now. They don't really offer many high street stuff. However, what being said, they offer a very, very chunky bit on your savings. However, it is only for 12 months. But as I say, if you're a new member here, you can crack on and do it and get the rate. A lot of people like to jump banks, don't they, for money? Well, this is another option of that. Now, the second bit of this, and the biggest obvious mistake, is the withdrawal rules. It's a mistake that people forget about. Now, with this website page, there's a thing there that says flexible, withdraw anytime. I gave it away before, right? So ISA contributions are a user or loser allowance, essentially. If you go over the yearly bracket, i.e. from April to April, right? However, old school mechanisms such as the cash ISA in Barclays, for example, HSBC and old school high streets, they don't have the word flexible in it, right? And that can be a very big mistake. Now, cash is cash. Cash is designed to be essentially an emergency fund, and you should really be kind of keeping that somewhere that is safe, but ultimately you want it to kind of not lose as much purchasing power as in Barclays. But with these ISAs and even the Monzo one and other ones like it, you can take money out and put it back in within that same tax year, and you do not lose the allowance. That is the point. Use it or lose it, right? So if I say wanted to buy a car and I put like say 10 grand in an ISA and it was trickling up nicely and making me a little bit of money, nothing crazy though, but I can then take it out and then I can move it about if I want to, or put some of that into a car or whatever and put whatever's left over back into the ISA. You do not lose that allowance. Whereas if you go in with 10 grand and out with 10 grand and back in again, that 10 grand allowance has gone. That is a real big problem, what the high street banks have. And again, lack of education. People don't know that. Now, the third bit, I've just pressed the tab button here. Avoiding the stocks and shares ISA. Oh, I know, we're going into the risk part. Now, this isn't so much investing, right? But I'm going to give you a couple of options here. So many people stick to cash just because they think investing is risky. I get it. I understand it. Index funds are really good. ETFs, individual dividend stocks, as I do. But you can also invest in the bond market. You can invest in the base rate on this platform, which is literally following the base rate, which is brilliant. Gilts, bonds, whatever it may be. They are nowhere near as risky as, say, buying into an individual stock, for example. Now, with this as well, you can see here you get a higher interest rate because it is in with the money markets as well. But as I say, people just don't quite like investment risk in the UK. Only 6% of adults, as of the last count, use a stocks and shares ISA. They are a relatively newish product. They've not been around for like as long as the cash ISAs. But the option here to make money in the stock market with a bit of risk and totally tax-free, unless you're in obviously US dividend stocks or whatever, you pretty much pay zero tax. Long-term growth of that is completely tax-free. But as I say, people don't look at it. People are scared to. But like always, like, follow, and subscribe if you want to follow my journey in the dividend portfolio, which I'm using that stocks and shares platform, which is obviously here. You can see my remaining allowance here. I've got so much here, and we'll talk about allowances in a minute. Whatever it's in, it's all there. In terms of my holdings, I've got some cash here that I need to reinvest. I've got an all-world fund here, which is doing pretty well. Some stocks and shares up and down, doing really well. Even over the course of time, you can see here, £8,876 return on my money. Totally tax-free. It's pretty awesome, really. But as I say, there's other things you can do here. You can literally earn interest on cash sitting, which you can see here. I know it's not much because I don't really have cash in here, but you get the idea. It's cool, isn't it? This, by the way, is my cash ISA, the totally different platform of it. But you can see here, I've made some money here. And when I was holding a little bit of cash, I was earning a little bit every single month, which wasn't too bad, to be fair, considering. Not bad at all, is it? Now, mistake number 4, and it is an obvious one, and we're going to go back a little bit to it. Not using your full allowance or waiting too long. Now, you can see here my remaining allowance, 9,309. Obviously, it's September right now. I've still got a good couple of months. My personal opinion is dollar cost average. I want to just put a random amount in every single month and let it automatically just reinvest that money that I put in. Sometimes just going 20 grand in April is probably not going to give you maximum opportunity in the market, because more importantly with that, you're going to have a situation where interest rates, if you're in a cash ISA or stocks or whatever, may well change in terms of price and interest rate. So you don't want to go all in and commit on one. Dollar cost averaging is usually the best and safest way. But with this as well, the compounding element works best the earlier you start. So if you do have it as a monthly going out fee, so to speak, or a standing order, you're going to get a set rate every single time, and it's quite easy, and you're not rushing in and going, oh my God. And also you don't want to panic in terms of I'm going to lump 20 grand in or 15 grand or 10 grand or whatever. You're better off just drip feeding it, because then you don't notice it. I know that sounds daft, but £500 per month for some people isn't a lot of money. But if you then go, oh, let's put 15 grand in, that could be quite a lot, even though it'll be the same amount over roughly a 12-month period, or even a 2-year period. The big situation is you've got to drip feed it through, but also using as much of that allocation as possible and making it feel as normal as you can as a standing order into a platform. And then you can generate that wealth over time. And the final one is wrong platform / high fees. And let me kind of explain. So obviously the likes of Monzo and, even Traded 212, Chase, whatever, very, very low fees, pretty much minimal. You don't really notice them at all. But you also have platforms that pay really high fees, which is mental, by the way, and it does add up. So this is Hargreaves Lansdown, a really good platform, but ultimately they can charge up to 0.45%, which is mad, right? Even though you are investing in stocks, you have to pay to use their platform, and it's kind of like a little fee that comes out. With the likes of trading 212, you will pay per fund. But the funds, traditionally, if you're in an all-world index, it's like 0.07%, which is very, very little, and nothing on the individual stocks, which is hugely important here. Obviously, yes, you've got stamp duty and stuff to kind of comprehend if you're in the UK. But stuff like that and other platforms, they can be quite high and they will add up, especially on managed platforms. So IG.com do a managed one and it's like 1.2%, which will obviously add up. So obviously if you add in, say, 1% per year, that could wipe off thousands of your return over a lifetime. A lot of platforms are set up like a SIP, like a pension where they're managed. That's fine for a pension. But for a stocks and shares ISA or a cash ISA and stuff like that, you don't really want to be paying monies for that, realistically, let's be honest. But luckily, with a cash ISA, you can kind of do it the boring way and you can get 0 fees on a savings account. But there's still situations where you can see charges, small charges, but nothing crazy. Now, there's a link on my description to Invest Engine. It is an affiliate link. However, capital is at risk, but I want to prove to you and showcase the fees here. I obviously showed you one before, but some platforms like Free Trade and even Interactive Investor is a monthly charge. For some people, that might be quite good. But obviously, some of the interest rates, obviously, in terms of like what you're getting, whether it is stocks and shares ISA or even a cash ISA, there may be, as I say, little fees involved. But they will obviously rack up very, very aggressively. And you can see how you are losing portfolio value very much over the course of time. And look at how much you've lost. 32,000, 22,000. You get the idea? Try and look after the pennies as much as you can. The whole idea of investing is to try and, keep off the tax man, or more importantly, the money flow. The capital appreciation of your money should be outbeating or outperforming inflation, which is obviously the money printer. Hugely important. But as I say, with all of this and whatever platform you're using, the value of investment and income can go down as well as up. Please make sure you know what you're doing, but ultimately, the right product will give you the right results. So there you go, 5 very, very, very simple mistakes that you may not realize you're doing that could actually cost you thousands. And if you've made these before, don't worry, you can fix them. You can always move or transfer ISAs if you want to. If you're paying a stupid fee on something that you can get for free and do the exact same thing, it's highly recommended you probably do move that because you could actually save a lot of money. Drop a comment if you've made any of these mistakes, but as I say, you can always redo them and rechange them and tweak it a little bit, and you may well find that some of your behaviors are a bit different moving forward. But yeah, there is some links to some of these platforms below if you are at all interested. But as I say, just keep it very, very simple. Cash ISAs are great in one way, but you need to get the best rates. For me, stocks and shares ISA is where you should be because that's where the most money can be. And if you've not yet done so, watch this video. That'll tell you about my journey to $1 million on my stocks and shares ISA.